Do stock valuations even matter? I know this is crazy, because the value investor looks at stocks that are trading cheaper relative to the enterprise value and whatnot. And the best way to do that would be like the Dodd, Benjamin Graham, was it Chris Dodd? I don't think it's Chris Dodd. I can't remember. Dodd Graham, where if you can buy a company for less than its total cash value, you're basically getting cash for free. So I don't know if you can do this anymore, just because the cat's out of the bag. But let's just give you an example. Say a company trades at $50 a share, just for simplicity. And we'll say the amount of cash it has is equivalent of $60 a share. So you could buy that company for $50 a share, and you'd have $60 a share of cash, which meant you're getting $10 a share for free. Well, if the valuations were 100, would you not buy that company? If it had all that cash on the side? Again, you got to look at debt and all that too, but that's a pretty easy one to do. You say, man, if I can buy the company for less than its cash, that's a pretty good place to be. You got to consider debt and all that. But would valuations really matter that much in terms of PE ratios if it had a price to earnings as high, but you still had more cash than price per share? I don't think so. Anyway, so I did a quick research. Hey, look at my man's got a Porsche Panamera, but he's got an NRA sticker on it. Where's that Marine Corps sticker? I think it's, I don't know. I'm not sure, because there's a Marine Corps sticker. Hey boy. There's an NRA sticker, yeah, but it's a Marine Corps sticker. Oh boy, oh boy. Anyway, so I was doing some research on the Nifty 50 stocks. I said, what were the PE ratios of the Nifty 50 stocks in 1972? And basically, no one really knows. I got those books from Jeremy Siegel. I got a couple of his editions, Stocks in the Long Run. We just don't identify the specifics of the Nifty 50, and you really can't. There aren't specific. There are a couple of different models that look at, but across the board, they're kind of along the same lines. But generally speaking, there's no explicit Nifty 50, kind of like the Magnificent 7 is explicit Magnificent 7. I'm going the wrong way. I'm trying to go, where the hell is Wendy's? Oh, yeah, back there. Apparently they got a mint Frosty, which I want to get. Probably should have went that way. Wait, where the hell is Wendy's? I can't remember. I think I'm going the wrong way for this Wendy's. Oh, dang nabbit. Too busy freaking yapping here. Where's Wendy's? Can't remember. Is it coming? Or is it in McFarland? Ooh, McFarland Drive. Yeah, there's one on McFarland Drive. All right, sweet. I love my Shamrock Shakes from McDonald's. And I haven't had this mint Frosty yet, so I'm going to try that. Anyway, so the Nifty 50, on average, is right about 40-45 is a PE ratio of the 50 stocks that, again, comprise the Nifty 50. And so in 1972, that was the PE ratios, and then the stock market proceeded to fall in 73 and 74. Interestingly enough, if you weren't pulling money off these stocks, 5-10 years later, you're fine. It's just that simple. And not all of them, but a good amount of them, you're fine. Which is interesting. And then you go back to figure out, what was the PE ratios previous to 1972? I don't know. This is one of the things I want to look at. What were the PE ratios of the Nifty 50 pre-1972? Because again, people say the valuations were so high. You're like, well, the valuations were also high in 1998, 1999, 1997. Hell, remember, it was in 94, I think it was 94 when Greenspan uttered irrational exuberance. That was in 94, dudes. And then we had I think 95, 96, 97, 98, 99. I think 95, the market was up like 5%. The next 4 years up like 30% each year until 1999. It's still at 21%. And irrational exuberance was uttered in 1994. And the PE ratios were going up and up and up and up and up. Just look at Cisco. You can look at Intel. Look at all this. You can't. So anyway, the point being is, do the valuations actually matter? And don't forget, in 2000, the large cap growth stocks of the NASDAQ got killed. But then in 2001, and certainly in 2002, the other stocks fell as well. Were their valuations nosebleed? No. Now, I tell you, for me, this is a tough pill to swallow, because I've always been low PE ratios, high price of books, high cash, low debt. You see what I'm saying? High dividend yield. But all these things are based on a cash specifically, but low PE, high price to book, high dividend yield, or low price to book, excuse me, low PE, low price to book, high dividend yield. That's all based on the price of the shares. That's a value stock, all based on the price of the shares. So low price to book, low price to earnings, high dividend yield. With the reason the dividend yield is low because the price is low. Dividend yield is high because the price is low on the share price. Ideally a high cash component and a little to no debt. If you can buy those stocks, you're probably in hog heaven. Whoa, watch out there, homie. Homie come lately. But does it matter? Because again, you have all these stocks that, I mean, they have PE ratios. Like, look at Tesla right now. It's over 100, man. It's over three figures. It's 152. And I was talking to a guy today. His capital gain, he had like $5,000 as his cost basis in Tesla. It's worth 150 now. Isn't that crazy? I mean, what does that mean? It has to pop? I don't know. A guy emailed me or on my X account, said, "What do you think about Bitcoin and BlackRock offering Bitcoin as part of their diversification?" I said, I think it's silly, but whatever. So Bitcoin has no value other than the greater fool theory. At the end of the day, Tesla still has a value, even as PE ratios are high. That's really the only electric car company worthwhile. It just is. Everything. What did Nikola just go bankrupt? I think I read that Nikola just went bankrupt. Nikola! And I don't know, I mean, Ford, what the hell is it? Not the Ford one. We had a plant here in Georgia for the other EV company, and I think they pretty much suck donkey balls too. I forgot what it's called. But at the end of the day, none of these other electric companies, car countries are doing anything. Tesla's the only game in town. And, would I pay for a Tesla stock? No, I certainly wouldn't. But again, that's because my old school way says valuations are too high. But maybe and there's two Teslas right back to back because I live in an affluent part of northern Georgia. Maybe valuations don't really mean that much relative to future returns. Or I don't say that. There is some studies that show you high valuations, lower future returns. Maybe valuations don't mean so much when it comes to getting hammered, though, if that makes sense. If I have high valuations, it doesn't mean the bubble is going to pop. Maybe it just means my returns are lower. And I think there's some validity to that. The 10-year cape, look back and whatnot. But high valuations in of itself don't signify an impending bear market. It just, it could. But it's like there's always a different side of the story. All right, love your thoughts. There goes the dog watch hidden fence guy right there. AtlantaDogWatch.com. Dude, you want to make some money, just be a freaking pet poop patrol guy. I forgot who was telling me this, but some guy said his kid is like 21 years old, making like $150,000 being a poop patrol guy. Picking up people's dog poops. Crazy. Anyway, all right, God bless. Love your thoughts. We'll see ya. Punch that like button. Punch it.